Hello and welcome to The Bond Economist. I am at Kolkata's ITC Shonar, and as you can see, they've left this cute presentation on my bed. So today's dose of economics is to be brought to you in collaboration with these cute ducklings. So here's the thing. You know how every once in a while you come across articles that say 5 signs that a girl is into you, and they say things like if she's looking in your direction, if she's smiling at you, if she's touching her hair. I mean, it's been a long time since any of this has happened to me, but look, if you rely on interest rates, be it your loans, deposits or investments, you need to not only watch out for when the RBI increases or decreases the policy interest rate, but also the signals that the RBI governor sends to you in his talks in the background on where rates are headed. And of late, Governor Shaktikanta has been a tad obsessed about the Mahabharata. He has mentioned in public a number of times how the RBI is maintaining an Arjuna's eye on inflation. This, of course, refers to that episode where Dronacharya asks his pupils to shoot at the eye of the bird, and he asks each one, "What do you see?" And the students mostly say branch, bird, leaves, and Arjuna is the only one who says, "I only see the eye of the bird." So basically, Governor Das wants to tell you that he is laser focused on inflation. And then recently he said this.
But think of another situation in Mahabharata when the youth Arjuna was participating in the Swayamvara. He had to take aim on the fish which was rotating on the top, revolving on the top, and he had to take aim through the water. So he had to also completely focus on the eye of the fish, because he had to hit the eye of the fish which was hanging, upside down. But at the same time, he had to see through the eye of the water, and there were ripples in the water. So he had to be mindful of what are the ripples in the water, what is the wind factor, how much of wind is there, the noise level in the room, and the other distractions all around. And he had to still take the aim. He had to still hit the target. So while being focused on the target and committed to hit the target, he was also factoring in the other conditions which will enable him to hit the target. So therefore, like that, the Reserve Bank is completely focused on achieving the target, but we do consider several other factors.
Now, if you have a kya expression on your face right now, well, this video is for you. And if Governor Das is going from child Arjuna shooting at the bird to young Arjuna in a Swayamvar, adult Arjuna went ahead and killed a bunch of Kauravas. So I shudder to think of the monetary policy equivalent of that. But hey, let's figure out what the RBI governor really wants to see. First things first, the RBI has a flexible inflation targeting mandate. What does this really mean? Well, inflation targeting in India would mean keeping inflation as close as possible to 4%. There is a band of plus minus 2%, which means that the RBI is allowed to tolerate inflation up to 6%. But it is answerable to the government if inflation is above 6% for 3 quarters. And by the way, the RBI actually had to write a formal letter to the government during the end of last year explaining why inflation was consistently above 6%. And the government has actually refused to make this letter public. Now, in theory, achieving lower inflation should be simple. Just keep raising interest rates. You make it very expensive to borrow, so consumption and investments get hit. The economy starts slowing down, demand for things goes down, and then that brings down inflation. But you see what the problem is, right? The RBI may get inflation down, but it will strangle growth in the process. So the RBI's mandate is flexible inflation targeting. So yes, you target inflation, but you also can't kill growth. And as it turns out, Arjuna wasn't always this focused on inflation. See, the pandemic was a really confusing time for central banks. Growth was damaged badly because of the lockdowns. And here's the problem. Inflation also started surging. For India, it picked up to close to 7%. Part of this was owing to firms being closed, activities restricted, so supply chains got disrupted. So if my supplier doesn't give me the raw material in time, I will have to either cut my own production or get it from somewhere else at a higher price, which means I need to increase the prices of my products too. And when this happens economy-wide, it causes higher inflation. Commodity prices globally were also rising. And so here's where the confusion was for the RBI. The rise in inflation, the recovery in growth post-pandemic, was this going to be temporary, or is this going to be more persistent which actually needed interest rates to be increased to control inflation. Because if inflation isn't temporary and you as a central bank keep interest rates too low, then the economy starts to overheat and then inflation actually becomes uncontrollable. And central banks across the world got this wrong. To use RBI's analogy, Arjuna was simply too distracted. Some in the markets were already murmuring by the end of 2021 that the RBI was just being too relaxed about inflation, too supportive of growth, and should start raising interest rates. By the first quarter of 2022, central banks across the world started getting worried that maybe they've been underestimating inflation. The pandemic was effectively over, inflation still wasn't. For the RBI, two events got a distracted Arjuna to focus back on inflation. First, the Russia-Ukraine war that caused commodity prices across the world shooting up. And two, and the RBI doesn't really publicly admit this, but the US started raising interest rates. So look, if the US raises interest rates and India doesn't, then the gap between the two starts to reduce. So basically, foreign investment flows in our markets realize that the interest rate advantage of parking their money in India reduces. And so if they decide to exit, they will dump the rupee and so the rupee depreciates. Now, the reason the RBI is very reluctant to admit that this was the reason behind starting to raise interest rates is because publicly, the RBI maintains that it does not target the exchange rate. It only steps in to manage volatility in the market. What is the problem in targeting exchange rate? Well, it effectively stops you from responding to domestic inflation. It doesn't matter what inflation is. Whenever US raises interest rates, you are also forced to raise interest rates to ensure that the interest rate difference doesn't get narrowed too much. So the RBI can't afford to be seen being on autopilot following the US. But the undeniable fact remains that when the Federal Reserve, that is the US central bank, raised its policy interest rates by 0.5% in May, which in the central banking world is kind of a huge thing because usual hikes or cuts are generally in the quantum of 0.25%. So the Fed does this on 4th May, and this is a big deal for the world. It means that historically low interest rate era is now over. The world is firmly entering into a new era of higher inflation and higher interest rates. And guess what? On that very same day, Governor Das hurriedly calls an emergency meeting of the Monetary Policy Committee that is basically in charge of voting on policy interest rate. So the meeting was as such scheduled to be held only a month later in June, but Governor couldn't wait. He called an emergency meeting on 4th May, yanked up India's policy rates by 0.4%, which has actually created a problem for the RBI now, because now markets are convinced that as long as the US keeps hiking interest rates, India will have to follow them. Again, if you met Governor Das, he would tell you, no, that's not the case. The RBI reacts only to domestic inflation as the main driver. But hey, once you've sent a signal, you can't really control how the other person will interpret it. So, whatever the trigger, the RBI eventually raised the policy interest rates from 4% to 6.5% in the past year, and from February of this year has been keeping interest rates constant. So, why did the RBI stop increasing interest rates? Well, a major reason was that inflation has come off quite a lot. Firms that were facing high input costs in 2022 saw a sharp fall in 2023 as commodity prices also fell. The government also leaned on oil marketing companies to keep petrol and diesel prices unchanged. And to some extent, the RBI's 2.5% increase in interest rates was essentially transmitting through the economy and doing their job. A combination of these got India's core inflation, so things like household goods and services, clothing, personal care, recreational stuff, to start trending lower. I mean, last year when the RBI started increasing interest rates, core inflation was around 6%. Currently, it's a little over 4%. But in all of this, the problem still remains that food inflation continues to remain high. And to be fair on the RBI, it's not really their fault. 1 month tomato prices shoot up by over 200%. By the way, we've done an episode of The Bond Economist on this. Do check it out. Currently, onion prices are shooting up. We've had really erratic monsoons, so prices of rice, wheat, dal have picked up quite a lot. And the RBI could be tempted to say that, look, all of this does not depend on interest rates. Why should I care? Well, there are two reasons. First is a technical one. RBI is responsible for overall inflation, regardless of whether it is because of food or because the government has done something to petrol prices or because the economy is overheating, which the third thing actually comes under the RBI's purview. The RBI as such, it doesn't matter what is driving it, is responsible for getting overall inflation down to 4%. And two, the RBI's nightmare is that, let's say food inflation is too high for too long. Then people start expecting higher prices in the economy for everything, from shirts to haircuts. They in turn expect higher wages from firms. Firms in turn raise prices of their goods and services. And that in turn leads to higher inflation. So essentially, high inflation leads to higher wages that feeds into higher inflation. The RBI's job is to prevent this from happening. And so while higher tomato prices or wheat prices are not in RBI's hands, it can still become RBI's problem. Now, the RBI expects overall inflation will slide down to 5.4% in FY24 from 6.7% in FY23. What does that mean for interest rates? So here's the deal. One way to look at it is that 5%-ish inflation isn't so bad. It is, after all, below 6%, and core inflation is moderating. And very importantly, wages in India aren't really growing that strongly. Amazingly, RBI's latest data suggests that household inflation expectations aren't picking up either, despite higher food inflation. So this wage inflation spiral that we talked about earlier isn't really happening in India. And so you can argue that, look, there isn't any need for the RBI to tighten interest rates further. But secondly, neither is there a strong need to cut interest rates now. See, you cut interest rates when growth is suffering, and growth in India has been exceptionally stable. I mean, at the time of filming this video, GDP for the latest July, August, September quarter has yet to be released, but overall growth seems to be driven by three things. First, aggressive spending on investment by the government. Two, the global economy evading recession so far, despite sky-high interest rates. And three, domestic consumption holding up, but probably more so by the better off consumers. Again, we've done an episode of The Bond Economist on the cracks in India's consumption story, and then another one on Indian consumers taking on too many personal loans. I'll leave links at the end. The point is that if growth does not show signs of weakening, then the RBI can very well say that, what's the urgency to cut interest rates? Which brings me back to Arjuna and the RBI governor's obsession with him. When central banks stop hiking interest rates, markets tend to expect that a cut in interest rates will soon come. And if markets start to expect that, then interest rates in bond markets start to fall. And that basically starts to reverse the rate hikes that the RBI has done so far. So when the RBI pauses, it tries to sound what in economics we call hawkish, which is basically to say, I may not be increasing interest rates right now, but I'm still incredibly serious about inflation. So the RBI keeps saying, inflation is still not close to my target of 4%. So markets, don't you dare start to price in rate cuts, because I have an Arjuna's eye on inflation. For more such insights, like, share, and subscribe to The Bond Economist.